All right. Good morning, everyone. Thank you for joining us on our second day of the 2023 Pivot Week. We had a great discussion yesterday from fabulous speakers who taught us more about self care and mental health. Today's topic, we're pivoting to business wellness. We're going to talk a little bit about money and finance. And our first speaker is CJ Carter. CJ is the founder and CEO of the CannaMercial Realty. He It all started in 2015 with his introduction into the cannabis space, where he laid the foundation for CannaMercial Realty by hosting licensing seminars, consulting, and brand development. As an entrepreneur, his expertise in finance, marketing, and operations provided the forward thinking needed to establish this new real estate venture. CJ also serves as the Minorities for Medical Marijuana Kentucky chapter director, giving him a deep connection to the local cannabis industry, advancements, and people interested in the industry. CJ, I'll go ahead and let you take it away.
All right, I appreciate you. Thank you for having me on this pivot week. I'm really ecstatic to share as much information as I can in the short amount of time that we have. So I'm gonna jump right into it. So just to give you guys a little bit of a backstory about myself, um, as it's been stated, I've been in the space since about 2015 in various facets. Developed a brand, did some marketing work, some finance work. Me and my brother, we came up with a CBD company called Comfy Hemp, where we had CBD tablets. We did that for about 2 years. And then things kind of changed for me in 2018 when I had the first seizure of my life. After the fifth seizure, I was diagnosed with temporal lobe epilepsy, which kind of left me in a place where it was hard for me to live life because of this new diagnosis that was thrusted upon me. So that's why I say that I'm a patient and advocate as well as an entrepreneur, because I'm kind of in all facets of the space. But everything starts with me with being a single father. I have two amazing young boys. My youngest turns 4 today, actually. So today is a celebration as I do this presentation, and looking forward to picking them up from daycare so we can continue our day. So I live here in Louisville, Kentucky. Louisville, Kentucky is an interesting place. A lot of people don't realize, but Kentucky is the epicenter for the cannabis space. We have the best soil in the world because we have limestone, which enriches every crop here with magnesium and calcium. So that's why bourbon is so big here, because we have corn, we have soybeans, we have wheat, all of which are staple crops. So we're working to establish cannabis and hemp to recapture the past that Kentucky once had as it relates to hemp. So when it comes to cannabis here in Louisville, we are actually 10 times more likely to have a cannabis arrest if you happen to look like me. The national average is actually 3 times more likely. So we're dealing with some interesting stats here in the States, where they just conducted some research where over 300,000 individuals have been charged with cannabis related crimes in the last 2 decades. And being that we're 10 times more likely to encounter a cannabis charge here in Louisville, you can only imagine what those numbers actually look like, even though they didn't go that far into the data in terms of race. So the one thing that I want to start off and let you guys know with about being in the cannabis space is the cannabis and the hemp space as a business is founded on self-study. So that's what I consider myself. I consider myself to be a student of the game. So I'm a student of the game who's actually learning the rules to the game. And the rules to the cannabis game are ever changing, due to regulatory issues, due to consumer sentiment. There's a lot that goes into the actual rules to this game. And cannabis has been in the news a lot here lately. We have safe banking, which is up for a possible hearing and a possible vote. And then you have the descheduling of the plant, which was been put forward by President Joe Biden. And then you have the 2023 Farm Bill, which should be coming up for a vote at the end of the month. And then last week, the NCAA came out and stated that they were looking to reconsider the cannabis policies that they have in terms of their collegiate athletics. So we know that cannabis and hemp, it's two sides of the same plant. and they differ mainly in terms of their chemical composition and their uses. Of course, cannabis has the higher THC, and then hemp has a lower concentration of THC. So we're talking about the medicinal and the therapeutic uses of both cannabis and hemp. But on the hemp side of things, something that's often never talked about is the industrial uses. Um, Hemp can be used for over 25,000 different things. And some of the markets that are looking to expand as it relates to the hemp space, of course, are animal bedding and animal feed. Then you have home construction materials, which is going to be really big in the years and decades to come, because you can build an entire house out of hemp, from the concrete to the framing to the insulation, to the molding to the roofing to the plaster. Any and everything that you need to make a house can be made from processed and manufactured hemp. So that's a huge space that is yet to be unfolded in terms of hemp. And then you also have car parts. Hemp can be manufactured into bioplastics. It can be manufactured into leather, to be used for door panelings, for dashboards. These are some untapped markets that are going to be developing over the years to come as it relates to hemp. So definitely keep your eyes open if you have any aspirations of entering the hemp space in terms of processing and manufacturing. That's where the actual real growth, in my estimation, is. So we know that the cannabis legislation, of course, it varies worldwide. Hemp has been federally legal here since the 2018 Farm Bill, and it has a lot of opportunities, much of which I have just mentioned. So we know that the cannabis and the hemp, they are significant economic drivers, and they have experienced rapid growth, here in the last 5 years alone, with the potential for further expansion as regions and states continue to legalize. And this presents enormous opportunities, but it also comes with unique challenges, largely stemming from the evolving market dynamics, and then, of course, the complex regulatory landscape, which is one of the foremost challenges when it comes to regulatory uncertainty, is the inconsistency that's around the legislation. Laws, they vary significantly from county to state to even municipalities, which makes it difficult for businesses to actually navigate compliance and to stay up to date with the current changes. So then this leads to another issue, is, of course, banking and financial services. Being that cannabis is still federally illegal and is considered a controlled substance, a lot of financial institutions that are hesitant to provide banking and financial services to cannabis related businesses. So this results, of course, in limited access to traditional banking services, which forces companies to operate primarily in cash, which, of course, presents a major security concern in terms of operational risk. So another challenge that we face, of course, is access to capital. Of course, the industry has been live for a number of years now, and it has attracted substantial investment, but it can be challenging for some businesses, especially for startups, to secure funding due to the perception of the high risk associated with the lack of the financial services and, of course, the regulatory concerns. And then, of course, you have the volatility of the market as a whole in itself. As I stated earlier, the regulatory shifts, you have consumer preferences, and then, of course, the supply and demand dynamics. So this puts businesses at the forefront to have to adapt to market fluctuations, which actually hampers a lot of capital that you could possibly take on as a cannabis business. So let's see here. I'm trying to see where you are on the slide. Okay. So in terms of market growth potential of the cannabis and hemp space, as I stated, it's very substantial and has been subject of considerable attention, especially due to the news that happens to be going on in terms of the updates that we have. Being that next year is an actual election year, we will hear cannabis a lot more as politicians are looking to garner more votes. Cannabis is going to be a subject in the news. It's going to be covered often. So with the market growth, it has to do a lot with the actual factors that have to do with your location, and how that relates to where you are in the supply chain, which determines how your outlook is going to be for your business. So, of course, this has a lot to do with the stigma that's associated with the cannabis and the hemp plant. But of course, as time progresses, this is going to diminish. As consumers, they're open to try new products in various forms, including edibles, topicals, as well as beverages. If when the FDA comes out with their guidelines and regulations to allow CBD and THC into beverages, that's going to be another um, sector of the cannabis space that will see some really explosive growth. And then, of course, hemp is used as a sustainable resource in terms of sustainable farming practice. Hemp has the ability to actually remediate soil. So we have brownfields all over the country. Here in Louisville alone, there are over 150 brownfields, and brownfields are pretty much old, dilapidated manufacturing facilities. They tend to sit there and there's nothing that can be done with them. There can't be any development on them because of the chemicals that have permeated and have uh, caused the soil to be toxic. So what you can do with industrial hemp is you can plant the industrial hemp crop, and it has the ability to absorb the chemicals in the soil up through their root structure and up to the actual stock. And then you'll have to remove that entire plant, and now you have remediated soil. So in terms of the versatility that hemp has, it is massive because, as I said, the hemp can be made into textiles, it can be made into biofuels, as I said, it can be made into construction materials as well. And this aligns with a lot of the green initiatives and the sustainability initiatives that we have here in America now, and that's also involved with several companies. All have sustainability initiatives where we're all trying to move towards a greener society, and hemp has the opportunity to lead that charge in terms of us actually having a green society. So let's go to the next slide. So capital requirements of the cannabis space, they kind of vary widely depending on several factors. So this has a lot to do with the different segments of the cannabis space, such as cultivation, processing, retail, and research. And it's critical to conduct a thorough financial analysis of your business plan to determine where your specific capital needs are to secure adequate funding for your sources. And of course, those capital needs go to one of the most important questions is the licensing. There are a lot of costs associated with obtaining a license, your permits, complying with the regulations. This includes, your application fees, your legal consultations, and your actual compliance infrastructure. So capital requirements also go along with the real estate in your facilities that you'll need to operate your actual cannabis business. And those that capital can be used to secure suitable real estate for the supply chain and the cultivation, processing, manufacturing, retail, delivery. And those costs also go to include for the purchase and the leasing, and then, of course, the construction for retrofitting your facilities and any ongoing maintenance that you would need. So, of course, you'd have to buy the equipment. That can include the grow lights, your irrigation systems, your extraction machines, and your laboratory equipment. And then, of course, you also have your cultivation expenses that are going to need high capital for you to buy your seeds or your clones or your nutrients or your pest control measures, and of course for your labor. The labor costs are going to be massive because you have to have highly skilled and experienced employees for, say, like growers, for laboratory technicians, for your compliance experts, and then for anything that's going to allow you to run a successful operation is why there are such high capital requirements, because that also goes to security measures, the insurance that you'll have. You have to have working capital. Typically, how it works in states, along with the application process, you tend to have at least $1 million in liquid cash or in liquid assets in order to even apply for a cannabis license. So the capital requirements often tend to help you with that working capital that you'll have. And of course, the main thing in the room, the main elephant in the room, of course, is taxes. In the cannabis space, we actually face higher tax rates compared to other sectors. And of course, this is on the federal, the state, and the local level. So you have your stages of funding, and we're all familiar with the stages of funding, meaning that you start off with your seed funding, then you have your startup funding, which leads to you having the early stage funding, which of course involves your angel investors, venture capitalists, and cannabis focused investment funds. And these funds are at the stage are used for scaling up the actual business in your early stage funding. And then, of course, you have your late stage funding, which involves private equity firms or institutional investors who are already looking to establish or to invest in well established and profitable companies in the space. So funding at each stage, it can be influenced by, of course, the regulatory changes, your market conditions, and of course, your location of your business. And some businesses may not follow the traditional funding trajectory, and they may bootstrap their operations relying on revenue generating or reinvestment of a fund growth. And the choice of the funding path depends on the business goals, your risk tolerance, and then the competitive landscape in your specific market. So yeah, let's go to the next slide. So yeah, let's dive real quick into equity investing and equity investments. Of course, this involves investors who are looking to acquire ownership or shares of an equity stake within a cannabis operation. This ownership provides investors with a claim or a portion of the company's profits or their assets, along with potential voting rights that will influence the company's decision. So the type of equity investors that you have, of course, are angel investors, and they often bring industry at VCs who are often mainly focused on high growth businesses. Much have to do with ancillary businesses because VCs tend to not want to be involved with anything that's plant touching. So if you have a technology or a software that you're looking to develop for the cannabis or hemp space, you'll be able to find some capital with some VCs because that's what they're looking for. It's something that's ancillary, that's not touching the actual plant. And this also plays along with private equity firms, as they're also looking for more mature businesses, and they're often focused on expansion and operational improvement. You have strategic investors who are also in within the space or outside the space, and they invest in startups or existing businesses to gain a strategic advantage to access new markets. So this is where MSOs come into play. MSOs are multi-state operators. Multi-state operators kind of value themselves on being vertically integrated, where they have the whole entire supply chain within their whole company. And then this is where they come in and they purchase licenses and they have acquisitions of different companies within the cannabis space. So strategic investors play a huge role in terms of merger and acquisitions with multi-state operators. Then, of course, we have the equity investment process. And of course, the investment process always starts with due diligence. And this due diligence has to do with evaluating your financial health, who your management team is, your growth prospects, and your competitive positioning that you have within the space. Then, after due diligence, of course, you have to come up with the actual valuation for your company. And this, of course, is determined through negotiations between investors and business founders. And the valuation kind of serves as a basis for your actual equity investment. And then after you have that valuation is then when you have your term sheet. And these terms are kind of agreed upon, and it outlines the key details of the investment, including the amount of capital that's going to be invested in the ownership stake, as well as the investor rights that are going to be generated through the next step, which of course is the investment agreement. Which of course is a formal agreement that is drafted and it outlines the terms and conditions of the actual investment. And the actual agreement, it will include the provisions that are related to the governance, the voting rights, and then the investor protections. So the actual benefits of having investors, of course, from an investor's point of view, is having the profit potential. As an investor, you actually have the opportunity to share in a company's profits, which is what investors are always looking for when they're looking at pro formas. They're looking to see how much money they're going to invest and when they're going to get their money back, at what level they're going to make in terms of profit. Then, of course, another potential benefit for investors is the ownership and the influence that they'll have in terms of the voting rights and the influence over the actual company decisions. Then, from another point of view from investors, is actually the diversification that you'll be able to accomplish in terms of your portfolio, where you can have, several different types of businesses within both the cannabis space as well as the hemp space, which is going to allow an investor to have a balanced investment portfolio within the space. And of course, with benefits, there also come risk. And of course, those risks start with the volatility of the market, because as we've seen, since things are kind of in flux and the cannabis space is actually in its infancy right now. Things kind of go both ways in terms of the risk, in terms of the market volatility, and of course, you have a longer investment horizon as a actual investor. Next slide. So real quick, debt financing is a common method for raising capital when you borrow funds and then you repay those funds to an investor over time. There are a couple of typical debt financing ways, which of course is traditional bank loans, which we kind of discussed already. And then you have your private lenders, who often have are hard money lenders, but with those hard money lenders, that's where your interest rates are a lot higher. Then you have lines of credit, which provides you the access to a predetermined amount of funds that can be borrowed and repaid as needed. And then you have the challenges associated with the debt investing. You have your regulatory hurdles, you have your high interest rates, and then of course you have the limited banking options because not all banks or financial institutions they're going to be willing to work with cannabis companies. Next slide. So then you have your investment funds. Now, the role of investment funds, of course, is when a group of investors, when they pool their money together and they have a fund manager that buy, holds, and then he sells the investments on your behalf. So these investment funds, they play a significant role in terms of actually providing a means of the funds to be used that'll help the business grow in terms of its growth potential. So the investments funds main ability is to actually provide that cash and capital injection. Um, and this is something that's much needed because the capital, it can be used for various purposes, including for you to actually expand your operation for research and development, facility construction, and then of course your working capital. And then with investment funds, they support startups mainly who have the access to traditional, who don't have the lack of access when it comes to the actual traditional financing due to the regulatory challenges. And investment funds, they often focus on supporting early stage companies who have those innovative ideas and helping them get off the ground. And then, of course, with investment funds, always comes in the tutelage and the experience and the guidance that they'll be able to provide, being that cannabis and hemp is a brand new industry. And then, of course, with investment funds, they also give you the access to networks that you may not be privy to in terms of being in the space. Next slide. So then we come to crowdfunding, and I'm sure we are familiar with crowdfunding. I'm sure everybody's heard of Indiegogo, Kickstarter, and Start Engine. So these platforms deal with equity crowdfunding and then rewards crowdfunding and then the debt crowdfunding. So of course, with the equity, the investors they invest and they get an ownership share. With rewards crowdfunding, this is typically where you don't receive any financial, anything financial. You'll get things such as products, merchandise, or you'll have early access to a service in exchange for your contribution. And of course, you have debt crowdfunding when this involves borrowing funds from a crowd of investors, and then you promise to repay that principal amount plus interest over time. Let's see. So let's go to strategic partnerships. So with strategic partnerships, they also play a pivotal role in the industry, offering businesses the opportunity to collaborate as well as to expand and thrive in the space. As I said earlier, the strategic partners actually offer you that access to the expertise in terms of your cultivation techniques, extraction methods, product formulation, the compliance. So anybody who's involved in the cannabis space, this is what you want to do. You want to develop those strategic partnerships because it's hard to work in your own silo in this cannabis space and you can't do everything alone. This is something that I had to learn where we have to get out of our working alone in our silos and we have to seek help and begin to work together because that's the only way you're going to be able to succeed in this space is by working with a team. Your team building is what actually determines your success in the space. So, of course, when you have strategic partnerships, this is also going to help you with your supply chain. The supply chain is kind of so-so in the cannabis space. I know in the hemp space, the supply chain is kind of non-existent because from cultivation to the delivery of the actual product, there is no collaboration in terms of supply chain. So having a strategic partner is definitely going to help you out with that actual chance of making your business a success. So with that, I see we only have a couple of more minutes, so I'm gonna cut this short and open it up for any questions that you guys may have. I know I kind of sped through that information, but 30 minutes is it flies when you have a lot to discuss. So, are there any questions?
Thank you for that, CJ. Lots of new and great information. I feel like much of this is such a new industry. For someone who wants to get into this industry, what would you what how what would your advice be for someone who wants to get into this? Like, what's the first thing someone should do?
I recently read a stat that if you spend 18 minutes a day
Mhm.
studying any particular subject, that's going to accumulate to 100 hours a year. So based off of that, that's going to allow you to be higher than 90% of the populace in terms of whatever field that you're in. So as I stated earlier, the most important thing in the cannabis space is there really is no education in this space. So everything is predicated off of your ability to be a student and being able to sit down and focus and self-study, because that's what we have to do in this space. I take the outlook of being a student. I don't know everything. I'll never claim to know everything, but I'm working to know as much as I can to better position myself in the space. So that's the one key that I would definitely tell everybody is you have to study in this space in order to set yourself set apart, because the competitive landscape is only getting harder day by day. The competitive landscape makes it hard for um, people to actually enter the space, and it can be seen as a barrier because people just don't know. So yeah, that'd be the main thing that I would suggest.
You mentioned earlier in your presentation that you're in Kentucky,
Mhm.
Louisville. Now, can you talk about what the landscape and cannabis landscape is like for the other states? Because SRMSCC has a four-state footprint: Arkansas, Louisiana, Alabama, and Mississippi. Are the rules and regs the same, or can you talk a little bit about rules and regs for each state or for states rather?
Yeah, so it's a state by state basis. Everything is different, every state. So I know in Louisiana, they have a medical program. Alabama is in the process of opening up their program. I know they're having some litigation as it relates to the actual licenses that they've granted. So there's it's crazy how different it is in each state, because here in Kentucky, our medical program, flower is not allowed. So our dispensaries are going to be very different than say they will potentially be in Arkansas, where our dispensaries are going to be filled with topicals, edibles, tinctures. That's what our dispensaries are going to consist of. So I know in Alabama they're going to allow flower to be sold on the medical side of things, and of course all of that changes when it comes to recreational. Of course, because odds are if you have a recreational program, flower is going to be allowed. And I know in some states they allow home grows for the medical program. So say if you're someone like myself, I have epilepsy. Um, I'll be able to have a home grow, say in Alabama, whereas here in Kentucky they don't allow home grows. So
Okay.
it's a case by case basis on whatever state that you happen to go into.
We do have a question from Brandon Sharp. She asks, can products be transported over state lines?
So it depends what type of product you're referring to. If it happens to be a cannabis product, that answer would be no, because it's still federally illegal, and that's interstate commerce. So it will not be able to cross state lines. Now, there are some exceptions to that, because here in the state of Kentucky, Governor Bashir last year he passed an executive order that even though we don't have a medical program yet here in Kentucky, his executive order allowed individuals who have one of 20 different conditions where you can go outside of the state. You can purchase up to half a pound of cannabis and you can bring that back to Kentucky. So his executive order kind of insinuates that he has suspended interstate commerce, which of course he can't do that. But in the vagueness of his executive order, it kind of leaves it up to interpretation. So that's how it kind of plays out in other states. Sometimes the legislation is extremely specific, but then sometimes it's kind of vague. So as I said, it's all a state by state basis. So you have to study your legislation, whatever state that you're in, your city, your municipality. You really have to study the legislation because it's the legislation that dictates how business is going to be run. So that's the first step in this space is learning the ins and outs of your legislation because then that's going to dictate how your business operates.
Gotcha. Oh, wow. So, CJ, for people who want to know more about your company and about the industry, would you mind dropping your email and your website into the chat so that people can kind of visit that?
Sure.
Your topic on investment is a perfect segue into our next speaker, Davorio Stevenson. Thank you, CJ, so much.
Thank you.
Let's give Davorio just a few minutes to get ready. All right. So Davorio Stevenson is the executive venture partner of Boot 64. Davario's experience includes Director of Investment Operations for a $25 billion pension plan for the Louisiana Teachers Retirement System. Davorio has also worked in the consulting and investment industry, advising and developing growth for large corporations, including Hershey Corporation, CBRE's Valuation and Advisory Group, and Bank of America Merrill Lynch. And I see Davorio is on. Davorio, I'll let you
Manny, good
go.
morning. No, thank you. And no, absolutely. You mentioned a perfect segue. I'm glad that I joined in time to hear CJ because many of the things that he was speaking to will relate to the conversation and kind of repositions my thought in terms of how we should kind of move forward. I think we'll be very high level on just an introduction to VC. So we'll take one of those pillars that he was speaking to and just kind of brush across, if you don't mind, on the topic. And look, I just jokingly, as I was listening to CJ, I'm like, wow, when folks say "still the thunder," he literally took and provided many insights that I wanted to provide. So I commend CJ on such a thorough approach on and very broad. And honestly, CJ, within 30 minutes, I think you were able to cover some of the most important topics. In terms of financing and also looking at the industry from its, a very nascent perspective in terms of all the opportunities out there in that specific industry. So, but again, Manny, thanks for the time. And if I'd be able to share my screen, I'm going to pull up a presentation real quick here. And let's see, can we get this done? Am I able to share my screen? Let's see. I don't see the option, but maybe I'm missing something here. Here we go. Okay. Good deal. Can you guys see that?
Yes, we can.
Okay, got it. Is it the entire screen?
Yes, sir.
Okay, perfect. So no, again, my name is Davorio. I reside here in Baton Rouge. Went to just a little bit of background. Went to Southern University, studied accounting. Graduated and realized I didn't want to be an accountant because it really, the practice itself, looks at what business have done in the past and from a record keeping standpoint. But I was more intrigued with, how business is forecasted and projected their growth, right? I decided to had a 3-year career with the Hershey Company where I was traveling, doing some things out of New York because our headquarters was in Pennsylvania. And all of a sudden, I'm like, dude, what's our exposure to cocoa prices? So I was more interested in our futures and forwards program and the way that we hedge cocoa prices because it was one of the main contributing factors to volatility in the product that, that was so vital to Hershey's business. And it just really, opened up this box of curiosity around just, the financial industry overall, right? So at that point, I decided to continue education and enrolled at LSU to receive a master's in finance. And from there was my exposure to venture capital. And to this day, that was back in 2014. And to this day, I still have this textbook that I keep as a Bible to VC. So what I'll do is kind of like to take this conversation from there, talk about my role as a director of investment operations at the Louisiana Public Pension Fund. And there, seeing a real world example, what we call invisible, or what I call invisible capital, but what others may call institutional capital. One of the items that CJ spoke to in his presentation. But I'll start off by just defining what is venture capital, and kind of giving these 5 main characteristics. I have some notes here, so I'll be kind of, looking away from the document as well, what we're presenting. But what is venture capital? So VC has 5 main characteristics. One that I like to, kind of elaborate on is, VC as a financial intermediary. Simply, thinking of how banks function in our lives as well, right? Characteristic 1 defines VC as a financial intermediary. This is similar to a bank because just as bank takes money from depositors and then loans it to business and individuals, a VC fund takes money from investors and make equity investments in portfolio companies, right? Typically, a VC fund is organized as a limited partnership, with venture capital is acting as a general partner, quote unquote GP, and the fund and investors are acting as the limited partners. And then a second note, a VC invests only in private companies, meaning that these are not publicly traded companies. So these are companies that, as it relates to this audience, a lot of small businesses, startups, companies that are even at the idea stage, right? So that's really the description that I would like to kind of share with the group in terms of private versus public companies. When we think about private companies, we should be thinking of any companies that are not publicly traded. Private companies versus public companies that are sold on the exchange. The third bullet point, and this is something else that CJ mentioned, was that VCs like to take an active role with helping support the growth of early stage companies. What does this look like, right? This, VCs, assume that there's a startup company that they found and identified, weeks ago, right? What should be expected of a good VC is that a VC has this experience in a specific industry that kind of supports, that entrepreneur, right? So let's say that I have a startup, I don't know, I'm just going to use an example, say a software company, right? It should be expected that a VC who has interest in a software company has a broad network of other VC professionals, not VC, but software professionals, and also be able to kind of support, an actual startup company with exposing them to that same network, right? So as advisors, as folks who have experience in the space, folks who can give actual advice on, some of the do's and don'ts of a specific industry. So it's more than just money that a VC typically provides. There's also deep insights and connections to networks that kind of help support their business on a day-to-day, and also kind of thinking about its growth as well strategically. Another another characteristic of VC firms is the primary goal is to maximize its financial return. And that's one thing I like to always put into perspective because, again, a lot of times VCs already have an idea of how we want to model and construct a portfolio. So this is, what I call the underwriting process, something similar to an underwriting process where we're looking to match companies with our quote unquote models, right? Where we have an idea of what we want to, or how we want to see the actual fund perform, whether we're looking at IRR or MOIC, multiple investment capital measures. But again, we kind of get out there with an idea of what we're looking for, which industry, what's the expected growth rates. But then we have to find those companies that can kind of help achieve those goals as well. Because again, folks say from time to, kind of have this conversation with friends from time to time about all the things that we're able to, to do when we're being introduced to companies and they speak to like, Davorio, how do you guys cover so much ground with so many different companies? And I always say that, to be quite frank, it's like a doctor looking at patients, right? There's 3 things that we're typically looking for, right? And that's the financial statements. That's a cash flow statement, the income statement, and a balance sheet, right? So those 3 things kind of give us the health and understanding of a business, because whether it's a peanut factory or a software company, those are the 3 things that we use to measure the health of a company. And then the last point I like to make is a VC to invest on internal growth of companies. Again, our goal is to invest capital, but not just provide and be a source of capital, but to kind of help that company grow, whether it's looking at staffing needs, marketing needs, more connectivity throughout the industry that they're looking to exist in. So it's more than just the capital that we look to provide. Now go to the next slide. again, helping define venture capital. And again, I kind of created this very simple chart, right? We started with limited partners. Your limited partners or investors are typically, it could be high net worth individuals, or from my background, dealing with a public pension fund where we, will commit, tens of millions, if not hundreds of millions of dollars at a time. And I like to kind of elaborate on that thought process. So again, at a public pension fund, we were managing about 25 billion at the time when I departed back in March. And every month we we're committing 100 million to some of the top investment firms in the nation, in the globe actually, whether it was BlackRock, whether it was TPG, KKR, those name brand names that have a long track record, but also some of your top VCs like Insight Ventures, TCV Ventures. These are groups that are technology crossover ventures. These would be groups that we would invest. Every month we would look at committing capital to what we call our private asset allocation. And another thing I like to bring into scope was the importance of consultants in that space. Even though we were 25 billion, had 7 investment professionals, we leaned heavily on our what we call our asset allocation. The asset allocation kind of drives and it's the roadmap for how we deploy capital. So again, it's more of a matchmaking thing at that time, right? Where you're looking at investment funds who have performance history. But again, they have performance history, they have a industry focus. We're seeing these funds over time as they come to market with, their concepts, their strategies. And again, we're there to kind of help channel that thought process along with our consultants who helped us with our asset allocation. We already know what our target benchmarks are over a time of period, whether it's the first 3 or 5 years. We have an idea how we're going to commit capital over time. So again, just speaking and elaborating on limited partners, again, our job is to deploy, as a public pension fund, was to deploy to VC funds. And currently now I'm at a VC fund, which is Boot 64. And again, we're managers of, asset capital where we're looking for portfolio companies to achieve performance so that we can have a successful exit, whether it's an IPO or sale of a portfolio company to a strategic partner. What do venture capitalists do? So I broke this down to 3 simple, broad things, right? Investing, monitoring, and exiting. With investing, and all 3 of these topics kind of break down the thought process and cycle, right? Within investing, there's things happening from us, prospecting new opportunities, being out in the market so that our fund is active and looking to deploy capital, or even if we're raising capital, right? But again, getting an idea of what's happening out there in the market, using some of our network to kind of bring in new prospects and vet them. But at that same time, we already have an idea of what we're looking to invest in, because we have our thesis and our mandates already set, upon announcing that we're looking to start investing. And then we already have a term sheet, right? A term sheet that we have general terms for that we can kind of use the level set as we engage with the portfolio companies or potential portfolio companies. But before we begin our due diligence process, we submit our term sheets to our partners or potential partners or portfolio companies. At that point, once there's a general acceptance of that term sheet, we kind of go into this process where we go into data rooms and deal rooms and look at the financial statements, the projections, any of the critical criteria that an entrepreneur or a quote unquote startup company may have to provide for us to kind of do our deep dive, if you will. Upon that acceptance, and again, I'm trying to summarize in this process. But once we have a set idea that we're going to make a commitment, one thing I like to speak to is that we see hundreds of companies. Maybe anywhere from 10 to 15% of those make it to the quote unquote due diligence stage. And at that point is where we really look to engage with the founder, the team, spend time within our network, having conversations about how we're expecting the performance of that portfolio company to produce returns for the fund. And then once we make the commitment, our job at that point, looking at the term sheet, is saying, we're looking at all the things that can kind of help protect our downside, whether it's the terms. We're also thinking about the actual security that we're investing in, right? Usually it's a convertible note at an early stage, where that investment is generating a small return, anywhere from 6 to 8%, but we look to convert at future rounds. And then also being able to monitor the company by being a part of the board seat, or having a board seat, being a part of those, those monthly calls, quarterly calls where we're getting updates, and we have to kind of steer the leadership and the decision making of the company as well in the monitoring stage. But all that is to achieve an exit where we generate our returns. And again, the exit also really provides a different level of skill set as VCs, because what we're looking to do is use our network, our expertise to kind of help kind of lay out that landscape of what the exit should look like, whether it's an IPO or a strategic exit with a strategic partner or strategic buyer. And negotiating, within that time frame, we're looking to maximize. So again, the more activity that we have with additional strategic buyers, the better it is for the actual return and exit of that portfolio company. I thought this would be an interesting thing to kind of speak to, especially within within the last 5 or 10 years. I think venture capital has really garnered a lot of attention, especially around things when we look at the 2% that we speak of venture capital going to minority and Black and brown businesses, right? And I want to kind of spell this out in terms of the quote unquote history of venture capital. And it's almost as if it was a thing of necessity, right? So it dates back to 1946, and I pulled this from one of my textbooks that I kind of keep close. But it dates back to 1946, and back then there was this thing where you would have these entrepreneurs that would go to banks, right, just as they do today, but didn't have any source of capital that could actually support them with their concepts, or even with growth plans, right? They didn't meet the criteria to be underwritten, to have the underwriting process work out successfully for them as traditional companies would. So out of necessity, right, this guy named George Doriot, right, American Research and Development Corporation, I think it's a very interesting story where they were supported by the U.S. Army. It was organized as a corporation that was publicly traded. And again, one of their quote unquote home runs with this company called Digital Equipment Corporation, which they invested $70,000. And one thing that I thought was really key is that around the performance of the actual fund, it produced an IRR of about 15.8%, but without the contribution of Digital Equipment Corporation, it actually would have performed at a 7.4% IRR. So what I think that's an important thing to note is that a lot of times in portfolio construction around venture capital, if there's an investment in 10 companies in that fund, there's one company that's probably carrying the bulk of that performance. And that example, I didn't put the details here, but that example of Digital Equipment Corporation kind of speaks to the significance of a company like Yahoo being in the portfolio in this early stages, or eBay or Google being in the portfolio in early stages, where investments that are made in these companies along with others. Imagine a portfolio of 10 companies, but the other 9 are underperforming, but it's the Yahoos, the eBays, the Googles, the Digital Equipment Corporations that really carry that significant weight of the performance. So that's something that's not, nuanced to ARD. That's something that's expected typically in all, especially early stage venture, right? The earlier, the more riskier, to CJ's point that he made earlier. But it's also a good notion to kind of gather that a lot of these times it's that one company, right, that's really driving the performance, that's satisfying all the return metrics for venture capital at early stage. And I'm sorry for just kind of blowing through this stuff, but I thought it was a few things that just need to be covered. Let's see. So these are, I can't see. Let's see. 1 second. Gotta move the screen around. It's cutting off half my screen. Give me 1 second. Can you guys still see, even though it's a PowerPoint, can you guys see it?
Yes.
Sorry about that. Just had to move some stuff around. Okay. Get back to that. All right, here we go. All right, so investment by stage, and again, CJ, this is another point that you had mentioned earlier. The stages of growth, I just want to kind of highlight those 4 quote unquote stages, and this is kind of vary by VC, but nonetheless, this is a general idea how we look at different stages. Seed stage, startup stage. Usually, at this stage, very early stage. Sometimes it's just a simple idea for an entrepreneur. Here you do find uses of smaller amounts of capital because of the risk associated with that stage. But again, even in my case with Blue 64, there's been opportunities that don't even have an LLC yet, right? We're still willing to have that conversation because we would advise that they, maybe domiciled in Delaware or sorry, incorporated in Delaware, but still domiciled here in Louisiana. So sometimes, again, even at that very early stage, idea stage, there's still opportunity for financing. Quote unquote early stage, I would define this or summarize this as a place where companies are still not profitable, right? They may barely have a concept that, or what we call MVP, um, um, where they can, actually demonstrate what the product does. But again, they may have their team put together. They may be spending on like office-based things of that nature. But again, they still need funding to kind of push the ball across the line in terms of product development. At the expansion stage, mid-stage finances, you'll see companies with traction. They may have limited sales, but still not be quote unquote profitable, right? Where they may be generating, let's say, $10,000 a month, but their expenses are 15,000, so they're burning cash at that very early stage. Mid stage. But again, they may need additional capital to kind of help support their growth and get them out of what we call the J curve, right, in terms of value. And then later stage, and again, later stages, that pre-IPO of stage where you see companies that are, have traction, have customers, may have, recurring revenues. But again, they may or may not be profitable because again, they may still have, negative cash flow that is occurring. But they do have a greater chance of having success at that later stage. And again, the ideal concept is to get them either profitable or growth pre-IPO ready. So again, just 4 different stages within the quote unquote early stage, the early stages of VC investing, right? Which differ from private equity. And then last but not least, I wanted to kind of use this. I thought this was a very captivating demonstration of the concentration of VC. And this is the most recent. I was actually looking at some older pieces of information, and it made me go back and get this a more recent, first half of 2022 data from PitchBook, where you look at the concentration of VC. And again, as I think about Louisiana in this conversation, where we stand versus markets like San Francisco, something as close as Austin, and then looking at the Northeast as well, trying to put those things into comparison. But as you can see, just a simple bar chart here where you see $52 billion of VC was allocated to San Francisco. And then, the next, second number up will be New York, right? The metropolitan area of New York. And you see, less than half that, right? So again, just wanted to put those things into perspective in terms of VC investing. I don't have the numbers on Louisiana, but there's a lot of things happening right now, especially with the SSBCI program, which supports us as well. That's really helped promote, what's happening in this ecosystem around VC and venture investing. I don't know how much time we have, but that's the last slide of the presentation. And yeah, I want to thank you guys for the time.
That is a great presentation. Thank you, Davorio. Lots of new information on alternate financing. So, Dario, we have many small businesses in our audience. Can you talk about the types of industry that you invest in?
Absolutely. And I don't know if my screen is still, here's a start. Okay. Yeah, so good question. My response to that is the favorite word, industry agnostic, meaning our team really consists of several entrepreneurs where we look at everything from biotech to music technology, everything except for real estate, right? But we do have or we don't have a industry focus per se, which is typical, especially in an early stage startup, seed stage fund, which we are a true seed stage fund, where we look at all opportunities. So no, good question. But specifically for Boot 64, we do not have an industry focus.
Gotcha. Here's a question from Sydney Grider. What is your ideal equity stake when investing in a young company? What are the parameters/qualifications?
Got it. So typically, especially at a very early stage, we're taking anywhere from 1.5 to 5% of the company. We're writing check sizes anywhere from 75 to 150,000. So our sweet spot is really $100,000 per investment. But again, these are truly companies have a valuation of the range anywhere from 2.5 to 4 million. So we're able to achieve that equity position that's sizable with the check size that's truly enough is small in size, right? $100,000 is a good number for a startup. But again, when you're ramping up growth, you're spending that money, $10,000 at a time, right? So that gives you 10 to 12 months of runway. So no, great question.
After you cut the checks or after you do make your investment, how involved are you in the company operations or in decisions?
Yeah, it depends, but usually, especially in the early stage, based on the way that we've been negotiating and just to be as transparent and in real time, we've committed to two companies already where we're negotiating our board seats and we're a part of the team in a sense, right? So again, you may have 3 to 4 partners. I'm thinking of a specific situation that we're evaluating now. We produced the term sheets, but in those term sheets, we're asking for a board seat. So that we can kind of have visibility and kind of help support the company up close. So yeah, again, another good question, but yeah, highly involved. We spend at least once a month talking to the companies that we invest in. So that's a regular cadence just based on where the company's stage is the company's current stage and things of that nature.
Gotcha. So you mentioned a book. Would you mind putting the name of that book and the author in the chat in case anyone wants to find out more information, as well as your company website if people wanted to learn more about Boot 64? Would you mind putting that in the chat?
Absolutely. I would have to get the name of that book because I don't have it with me. But I get the name of the book and the author. And
Gotcha.
there's several out there that are really good. But yeah, the book that I was speaking to was actually a textbook from a course that I had. But definitely, I would look to share that information. And in terms of my email address and Boot 64's website, it's simple, Davorio at boot64.com. And the website is, of course, boot64.com. So I'll drop it in the chat immediately.
Gotcha. Perfect. Well, thank you so much for that, Davorio. Very intriguing. And so this moves us to our final speaker for today, Sylvester Johnson. Sylvester Johnson serves as the Business Development Officer for NewCorp. Mr. Johnson is responsible for relationship building with current and potential clientele and outreach to the community, specifically informing them about our financial products and services. Sylvester looks for opportunities to increase NewCorp's exposure to disadvantaged business enterprises, new and emerging small businesses, and future partners. NewCorp's clients are its business, and Mr. Johnson is the front-facing manager tasked with acquiring new business and broadening NewCorp's reach. Sylvester, I'll let you take it away. Welcome. You're on mute, sir.
I muted myself so I wouldn't interrupt Davorio and left myself there. Well, good afternoon, everyone. I am happy and privileged to be here to share a little bit about what we do at NewCorp and the opportunities that may be available to you and your small business that are outside of traditional financing or traditional capital. So what I'm going to talk about is initially we're going to discuss what NewCorp is, and I have my timer on so that I will be on time and on schedule and not run over. So NewCorp is what's called a CDFI. So the CDFIs are community development financial institutions. Not everyone knows what CDFIs are. We all know about banks. Obviously, we know about equity capital, venture capital, investors that invest in your businesses for a piece of the business itself. Traditional capital from credit unions and banks, that is debt financing that will come in, and you have to meet a certain credit score, make sure that your financials are in order, and meet with your banker so that you can secure debt financing that you'll pay back over time and at a specified interest rate. Well, CDFIs are a bit different than your traditional loan bank or your traditional credit union. What CDFIs do is we do our best to, yeah. Can you give me the other slide first? If you can. There we go. Yeah. See, thank you. CDFIs are institutions that focus on lending to minority-led, women-led, and disadvantaged small businesses. And NewCorp has been based in Louisiana, in New Orleans, for almost 30 years now. NewCorp was born out of the opportunity to have minority and women-led small businesses involved in the development of the downtown casino, which was Harrah's and is now changing brands over to Caesars. But when Harrah's first came in, one of the most important things to the government was that minorities get an opportunity to be involved in the development. So minority contractors and consultants were tasked to find a way to be involved in the construction. NewCorp was built or was developed so that we would be a conduit for those minority contractors and consultants to get involved with Harrah's Casino. And as that project went on and was completed, we realized that small businesses, minority-led and women-led, needed a way to either start, grow, and expand, or prepare their business to get to a point where it could actually compete in the marketplace with its majority partners. Therefore, NewCorp was born. So we focus on disadvantaged and minority-led businesses as a nonprofit. We are not a bank. We don't take deposits. All of our money comes from philanthropic sources, or it comes from government, federal and state and municipal programs that are put in place so that small businesses are able to access capital in ways that they are normally not able to. Sometimes, as a small business, we are not prepared to go into the bank and have the requisite credit scores or the requisite repayment capabilities that are necessary to get a line of credit or to get a term loan to begin our small business. Now, there are programs through the SBA, there are programs through the federal government that certainly allow small business to access capital, but sometimes that can also be outside of the reach or scope of some of our smallest businesses. It does not, needing capital does not have an amount attached to it. Some small businesses need as little as $10,000. Some banks may not be interested in that type of loan because a $10,000 loan does not give them the necessary servicing costs that can make that loan profitable to the bank. So banks will partner with us. They will go outside of us at times and to other CDFIs and give us tranches of money that they want to put into the minority or disadvantaged marketplace, but they cannot do it on their own. So we seek out clients that can take advantage of these tranches that were philanthropically given to us, but that are still looking for some type of return, even if that return may be a little lower than the normal return that you may find in the normal markets. So we have a couple products that are on the page right here that we are consistently revolving. So at NewCorp, we focus on a couple different types of small businesses. So even though we are really involved with small businesses from startup through expansion, one of our main focuses are contractors. Contractors are a bunch that sometimes find it hard to get funding or to get lendable funds because let's be honest, general contracting and subcontracting can be a very risky business. It takes a while to build up a basis so that you are able to take advantage of some of the larger contracts that have the larger margins. So a lot of times our small contractors are working on projects that may have smaller margins that will result in the smaller profits as they go along. But you get stuck on a revolving wheel. So with those smaller markets and smaller profits, the profits go directly into the next set of projects, and we can't take the time to get ourselves into a place where we're able to grow. So in comes the Bill NOLA Mobilization Fund, which is actually twofold now. It's both Bill NOLA and Bill Louisiana. So products with the municipal governments in Louisiana or in New Orleans Pacific, we are doing our best to help smaller contractors expand into bidding on projects that they can work through with the city and the state. A lot of times, the issue that comes along with that is it is very hard for smaller contractors to foot the bill and put money out front while they wait for the state or the city to pay them. Those terms can be net 90 and sometimes end up being net 120. Where we come in is once you're able to show a contract has been secured, you're able to ensure that you're working on the project and that you're invoicing either the prime or the city themselves. We have a product that allows you to work with us so that we can mobilize some of those invoices, similar to what factoring companies do, but without some of what at times can be predatory. We are able to give you funds based on your contract amount and based on your invoicing amount, so it can hold you over for materials, it can hold you over for payroll, it can hold you over for those things that are necessary while you are working the project and waiting on the net 90-day payment. It's important for our smaller contractors to be able to play in this marketplace, because that marketplace is where they are poised for growth. If we are able to give them an advantage, which is a lifeline to keep them from performance of the job all the way through the payment, we're able to help you to secure those profits in a manner that allows you to keep the job going without fearing running out of money while you're waiting on your invoice to be paid. That is the Bill NOLA and Bill Louisiana Mobilization Fund. It is specific to minority disadvantaged contractors, and it's specifically made or specifically put in place for contractors to be able to hang on to the state projects or these municipal projects until that first invoice payment is made, and they're able to then build up and keep the job moving when the invoicing and the payment becomes more consistent. So that's one of our programs. The next program is one that I briefly mentioned earlier, but that is available to, again, our smallest of small businesses. A lot of times, our smallest of small businesses is they're beginning to get off the ground, and maybe it's not a product that is poised for venture capital, or not a product that is poised for equity capital. They're looking for smaller amounts of money that will enable them to get their product into a brick and mortar building, or be able to produce more of their product than they have been able to previously. And I apologize. I'm looking at the notes that popped up here, but that product is called the microloan fund. So the microloan fund, what it does is it gives businesses access to funding for as little as $1,000 up to $50,000. Now, from $1,000 to $50,000, some of that lending, most traditional lenders won't touch. Again, like we talked about, it's too small of an amount of money to get it to make it profitable for them. But we're here to put that money into the marketplace so that smaller businesses that are trying to get to a place where they're going to grow, or they're going to begin to expand, can take advantage of these smaller amounts of money and use it to build the business without having, because not all of our minority or women-led businesses have friends and family that can either loan or invest in their businesses at its infancy. So we're here to try to boost you into a place where you're able to take your business to a step to get it set up and focused on moving over to what's going to be your larger loan request or your larger equity investment. And lastly, one of the traditional projects is it's our RCF fund. It's just our revolving capital fund. It works like a line of credit for our businesses that are more established, but they may not be able to be approved by a bank, or there was some complication with credit score or repayment capacity. We have a little more flexibility in our underwriting box that allows us to review and take a look at the full picture and find out if there is a way we can fit you into a place where it will be a good fit for either a term loan or a revolving line of credit that you can use for equipment purchases, payroll, really managing you into again a larger product that you'll be able to continue to work with us, and hopefully eventually graduate into a place where where you are prepared for your banker's questions and your credit is in a place, or your repayment capacity is in a place where your banker will be able to extend you a line of credit traditionally. So that is very important. The growth of our small businesses and its expansion, it's very important to us. It's part of our mission. We are a nonprofit, so everything that we're doing with a mission-based mentality, because we want to ensure that our DBEs, our MBEs, our women-led businesses, our WBEs have access to funding that may not be available traditionally. The note that came into the chat there, are we available outside of Louisiana? So currently, as we are looking to expand, we are focused on the Louisiana market, but I have multiple partners that are CDFIs that work outside of the market. So reaching out to me, I can certainly put you in contact with some of my partners that are doing the same type of work, if not exactly the same, but working on the same mission as I'm working on in the state of Louisiana, outside of Louisiana, in the Gulf Coast, out in the Southwest, and in the Midwest. Even at the conference last year, I even met some of my financial partners that are doing some really good business in the Northeast. So I have contacts outside of the state of Louisiana. If you're in Louisiana, I want you to work with me, but outside of Louisiana, I have contacts that I can put you in touch with that have the same mission and are doing the same work that we're doing. Now, for all of my or any Louisiana businesses that are on the webinar today, I want to talk specifically about a program that is a state-led program. It's one of those programs that that I was discussing before, that was not philanthropic, but that was built through state financing and federal financing, and we're the intermediary that is trying to get it out into get it out into the marketplace. And it's one of the best programs that we currently have for small businesses that are looking to grow. Can I have the next slide, please? Okay. And that program is called Restore Louisiana. Now, this program is specific to Louisiana. It's a Louisiana small business program that the federal government provided funds to the state of Louisiana because they had experienced multiple catastrophic hurricanes in both Lake Charles and in New Orleans and the river parishes. This program is one that is poised to help small businesses that were affected by those disasters. So either by the hurricanes in 2020 and 21, and there were also some pretty bad floods that happened in 21. And if any of those affected your small business, you're eligible for these funds. Now, what does affected mean? Affected means you would either have to have experienced a $10,000 physical loss, or you would have to have experienced a 20% decrease in revenue from the years 2019 or 2020 as compared to 2021. So 2021 would have to be 20% lower than either your revenue in 2020 or 2019, and that's as viewed by your tax returns. Now, to qualify for the loan, they're looking for businesses that have 1 to 50 employees, so it is for small businesses. And if you don't have an employee proper and you're a sole proprietor, you are looked at as an employee of your business. So you would have to have been in business during the disaster during 20 and 21, and there is a minimum of $25,000 in revenue that you would have had to have shown on your tax return. Now, we are one of the intermediaries that is pushing the program out, and the state is dying to give this money away. They have to. They do not want this money to sit, because the federal government has given it to them to distribute. The best part about the money here in Louisiana on this instance is, one, it's at 0% interest. And I'll say that again because I had to ask 2 or 3 times when they told me. It's at 0% interest. And 40% of the award amount is forgivable, meaning they will erase 40% of the loan amount after the first 60% is paid. Let me give you an example. If your award amount is $50,000, there's a $50,000 award. They give that to you at 0% interest for a 5-year term. So basically, you're only paying back what you borrowed. There is no interest attached. I say it again, there is no interest attached. And once $30,000 of the 50 is paid back, they forgive the final 20. It is forgiven. That means they will erase that debt, and the $30,000 that has been paid back will satisfy the loan payment. This is a program that anyone who was affected needs to look into and try to try to take advantage of. If you are in Louisiana, if you know someone in Louisiana, the small businesses need to make sure they look into this program. We will help you fill out the application. We will ensure that you get all of the documentation necessary. And even though there's a 600 credit score requirement, they will have exceptions that they are granting for people that are below 600 for whatever reason. Life happens. COVID happened. We had these storms. A lot of things have been rocking our small business market as of late, but it is imperative that we do our best to try to get these dollars in the hands of Louisiana small businesses, because it's a win-win for all businesses involved. I would like to wrap by saying, please do not hesitate to give me a call, shoot me an email. I'll put my email in the chat so that you guys can take it down. Please reach out to me for Restore or for any of our other products that are available. And lastly, as I said before, if you are outside the state of Louisiana and you are looking for a CDFI partner that can help you to get into the marketplace, again, reach out to me. I am certain my partners would love to work with you and to advance this mission. I'm so appreciative of being included here during Pivot Week, and I want to leave a little time just in case there are any questions in the chat that I need to respond to or answer.
Yes, thank you, Sylvester. We do have a question from Sherry Green. Will we get this information after the presentation?
Yes. So I will forward the information for Restore. I'll forward that over to Manny so she can make sure that's available to you. And I will forward over the information about our products and my email address and NewCorp's website so that you'll have that as well.
Perfect. Sherry, would you mind putting your email in the chat and we'll get this information to you? All right, one final question. Is there a deadline to apply or until the funds run out?
Okay, so for Restore, that's a good question. It's something I left out. The deadline to apply for Restore is December 31st, 2023. So it's the last day of this year. Okay,
gotcha. We'll make sure we get that information out.
And I just tossed my email into the chat for anyone who wants to pull it and reach out to me by email. Just in your subject line, just put 2023 Pivot Week.
Perfect. All right. I believe that are all the questions that we have. We had a great day today discussing money and finance and business wellness. Thank you, Sylvester, for that. Very timely. And that wraps up day 2. Please join us back again tomorrow, same time, same place, where tomorrow we will discuss community wellness. And with that, I bid everyone a great lunch hour. Have a good one, everyone. Thank you for joining us today.